Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Great to be here.
So, it is Friday, February 20th, 2026. And today we are jumping into a deep dive on two of the biggest, I guess you could call them ghosts, haunting the financial headlines this week.
Yeah, the headlines have been pretty relentless lately.
Oh, absolutely. We're talking about what we're calling the tariff tab and the deficit balloon. And look, I know when people hear macroeconomics or, trade policy, their eyes just tend to glaze over.
Oh, for sure. I mean, it can definitely feel like a foreign language.
Right.
Like it's just a wall of acronyms and percentages designed to keep regular people out of the loop.
Exactly. But buried in all those boring reports is the actual story of what things cost. It's the story of where the country is heading, right?
Yeah.
So our mission today is to translate that high-level data into plain English for you.
Because it really does impact everyone.
It does. We want to look at how these massive policy shifts actually hit your wallet, whether that is, your weekly run to the grocery store or checking your retirement account.
Yeah, the real-world application of all this.
Right. And based on the data we have on the table today, we've got fresh numbers from the New York Federal Reserve, the Bureau of Economic Analysis, and some really solid reporting from Reuters and the AP.
And we are going to look strictly at the numbers here, not the political talking points.
Yes.
Because according to recent analysis, the data tells a very specific story about who is actually paying for these policies and whether they're, doing what they were supposed to do.
Exactly. We are not picking sides today. We're just the messengers trying to figure out what this means for your money. So let's set the stage. We have two main topics today. First up is the price tag.
Right. The big question.
The Trump administration has implemented these new tariffs. And the debate in the media has always been, who writes the check? I mean, is it China? Is it Mexico? Or is it the American consumer?
That is the multi-billion-dollar question, isn't it?
It really is. And the second topic is the scoreboard. We literally just got the 2025 trade deficit numbers yesterday. And the whole point of these tariffs, the whole justification, was to shrink that gap, to buy less from the rest of the world than we sell to them.
Right, to bring that deficit number down.
So the question is, did it work? Or did we just shuffle the deck chairs around?
Spoiler alert on that one. The deck chairs have, they've definitely been shuffled.
I figured as much. All right, let's jump into section 1. Who actually pays the bill for a tariff? I was reading through the New York Federal Reserve study that just dropped.
The one analyzing customs data.
Yeah, they analyzed all the customs data through November 2025. And the findings are, well, they're pretty unambiguous, honestly.
They really are. I mean, the New York Fed looked at what is actually happening physically at the border when goods cross over. And based on the data, they found that nearly 90% of the tariff cost is being borne by U.S. companies and consumers.
90%.
Specifically, the study puts it between 86 and 94%. That tax is staying right here in America.
See, that is a massive percentage. And I think a lot of people, before I started studying this stuff, I had this idea too. People think a tariff is a bill that the U.S. government sends to a foreign government.
Right, like an invoice.
Yeah, we literally mail an invoice to Beijing or Berlin and say, hey, you owe us $1 billion. But that is not how the mechanics of a tariff actually work, is it?
No, not at all. A tariff is fundamentally a tax collected at the U.S. border.
Okay.
And the person paying that tax is the U.S. importer. It's the American company bringing the sneakers or the electronics or the steel into the country. They write the check to customs.
Right. So in theory, for the foreign country to actually pay for that tariff, they would have to lower their selling price to offset the tax.
Exactly. So if they drop their price by the exact amount of the tariff, then the U.S. importer pays the same final price they always did, and the foreign company just eats the loss.
But the data shows that isn't happening.
Not even close. There was a report from the Kiel Institute in Germany that backed up the New York Fed on this. According to their research, foreign exporters only lowered their prices by about 4% to absorb the cost.
4%? I mean, that's practically a rounding error.
Basically, yeah. They are refusing to absorb it.
Right.
They're looking at the U.S. and saying, look, if you want our goods, the price is the price.
Okay, let's play this out with an analogy because I think it helps to visualize the actual flow of the money here. Let's do a hot potato analogy.
I love a good analogy. Go for it.
Okay, so imagine a foreign company sells a widget. Let's say it's a high-end blender, right? And they sell it to a U.S. retailer for $100.
Okay, $100 blender.
Then the U.S. government slaps a $20 tariff on it.
Right.
The foreign company says, I am not lowering my price. It is still $100. So the U.S. importer, the store, has to pay the $100 to the foreign company plus the $20 tax to the U.S. government.
Correct. So their cost is now $120.
Exactly. Now that U.S. importer is holding a hot potato, that extra $20 cost. And they can't just hold on to a hot potato forever because it burns their hands. It burns their profit margin.
Right. If they just eat that $20 cost, they have less money to hire workers or keep the lights on. Their margins get absolutely crushed.
So naturally, what do? They toss the potato, they take that blender, put it on the shelf, and raise the retail price to $120. And who catches the hot potato?
The customer.
You and me. We catch it at the checkout counter.
That is exactly what we call direct pass-through, and that is what the data says is happening roughly 90% of the time. The cost just flows directly to the everyday consumer.
Right.
But there is actually a secondary layer to this that I think is even more important for you, the listener, to understand. It's a concept that researchers at Harvard Business School call indirect pass-through.
Indirect pass-through. Yeah, I saw that term in the reports. It sounds super technical, but it's actually really intuitive once you break it down. It's basically the umbrella effect on prices.
That is a perfect way to put it. Alberto Cavallo and his team over at Harvard found that when the price of imported goods goes up, the domestic competitors, so the companies making things right here in the USA, they don't necessarily keep their prices low.
Because they don't have to anymore.
Exactly.
Let's use a really simple daily example to explain this one. Let's say there are two pizza shops on the same block.
Okay.
One of them uses imported Italian cheese, and the other one uses domestic Wisconsin cheese.
Makes sense.
Now, the imported pizza place has to raise their price for a slice from $3 to $4 because of a new cheese tariff.
Right. They call it the hot potato.
Right. Now, the domestic pizza place across the street, they were selling their slices for $3 just to stay competitive. But once they look out the window and see the other guy charging $4...
They have an epiphany.
Exactly. They realize, hey, I don't have to charge $3 anymore. I can raise my price to $3.50 or $3.75. I am still the cheaper option on the block, but now I'm making way more profit per slice.
Precisely. The competitive pressure on that domestic company relaxes. The umbrella opens up. They take the opportunity to expand their margins. So the tariff doesn't just make the foreign goods more expensive, it gives the domestic companies pricing power.
It acts like a green light, a signal that it's totally fine to raise prices across the board.
Which brings us right back to that scary I word, inflation.
Inflation, yeah.
A tariff essentially acts like a broad tax on the entire economy. It pushes up the overall consumer price index, the CPI. So if you are an investor or honestly just someone trying to budget for the month, this is exactly why your grocery bill or your home renovation costs might be creeping up.
Even if you go out of your way to buy American-made product.
Exactly. Even the American-made stuff gets more expensive because of that indirect pass-through.
Okay, now we do have to be fair here and look at all sides. The White House is not just sitting back and agreeing with this New York Fed analysis.
No, they are not.
In fact, there is a pretty heated, very public dispute happening right now between the administration and these economists.
That is putting it mildly. The National Economic Council, the NEC, they pushed back very hard on the Fed report. Kevin Hassett, the NEC director, actually went on record calling the analysis partisan and inappropriate.
Partisan and inappropriate. I mean, that is incredibly strong language to use against the Federal Reserve. Usually these kinds of interagency disputes are handled quietly behind closed doors.
It is extremely rare to see it play out like this. But the administration's core argument here is that the Fed is just looking at a snapshot, not the whole movie.
Okay, what do they mean by that?
They argue that, sure, while prices might rise in the short term, these tariffs create a protective barrier. And that barrier encourages companies to pack up and build their factories here in the U.S.
Right, reshoring.
Exactly. They believe this will eventually lead to higher wages and way more manufacturing jobs, which in the long run will outweigh the higher prices at the store.
So the argument from the administration is essentially short-term pain for long-term gain.
Essentially, yes. But for you listening right now, especially if you're an investor, this public fight itself is a risk factor. In the financial world, we call this policy regime risk.
Break that down for us. Policy regime risk.
Well, when the White House and the Federal Reserve are openly fighting over the basic underlying facts of the economy, it creates a lot of uncertainty. It signals volatility. And if there's one thing markets absolutely hate...
It's uncertainty.
Right. Markets hate uncertainty. If the people pulling the economic levers are not in sync, it becomes really hard to predict where interest rates or tax policies are going to go next month.
It's kind of like being in a car where the driver and the navigator are just screaming at each other about which map to use. It makes the passengers in the back seat really nervous.
That's a great way to put it. And until that argument resolves, we can expect the markets to be a bit twitchy. You'll see more volatility day to day.
Okay, so that covers the cost side. We are generally paying the tab, and there's a lot of debate about the long-term payoff. But let's pivot to the second big topic for today, the scoreboard.
The trade deficit numbers.
Right, because the whole justification for these tariffs, the main goal, was to fix the trade deficit. We wanted to stop bleeding money to foreign countries.
That was the stated objective, yes.
So, looking at the data released by the Bureau of Economic Analysis yesterday, these are the final 2025 numbers.
Hot off the presses.
Yeah. And the headline number for the trade deficit is roughly $901.5 billion.
901.5. That is the number.
But context is everything here. If we look back at the 2024 number, it was around $904 billion. So despite all the tariffs, despite all the political noise and all the price hikes we just talked about, the deficit is basically flat.
It is almost statistically identical. The gap didn't close. And actually, if you dig just a little deeper into what they call the goods deficit.
Which is what exactly?
It's just the physical stuff. So it excludes services like banking, software, intellectual property. If you just look at the physical goods crossing the ocean, the deficit actually hit a record high of $1.24 trillion.
A record high. I mean, that seems completely counterintuitive. If we are taxing imports heavily, why on earth are we still importing so much stuff?
Well, the composition of where we get the stuff changed, even if the total amount we bought didn't. This is what economists call the balloon effect.
Oh, I love this visual. Explain the balloon effect for everyone.
Okay, imagine a balloon filled with air. The air inside represents the massive U.S. demand for imported goods. We love to buy things.
Right.
Now, if you squeeze one side of that balloon really hard, let's say you grab the side labeled China and squeeze it, the air doesn't just vanish into nothing.
No, I have to go somewhere.
Exactly. It just rushes to the other side of the balloon and makes it bulge out somewhere else.
So we squeezed China with the tariffs.
And imports from China did drop. They dropped significantly. But imports from Mexico, Vietnam, and Taiwan surged massively to fill that exact gap.
Wow.
Based on the data, we didn't stop importing. We just switched our dance partners.
So instead of the sticker saying made in China, you flip it over and it says made in Vietnam. But the dollars are still leaving the United States.
Correct. And to make it even more complicated, often those goods from Vietnam or Mexico are actually built using Chinese components anyway.
Oh, really?
Yeah, they're just shipped to a different country for final assembly to dodge the U.S. tariff. So the supply chain just gets longer, it gets more complicated and more expensive, but the total deficit number doesn't move much at all.
That makes a lot of sense. Now, there was also a note in the AP report about something called front-running. That sounded like a major factor for why 2025 was so high.
Oh, it was a huge factor. And it really just comes down to basic human nature. Think about it. If you knew that your absolute favorite coffee was going to double in price on January 1st, what would you do in December?
I'd go to the store and buy every single bag on the shelf. I'd fill my entire garage with coffee.
Right. And that is exactly what U.S. companies did. They knew the tariffs were ramping up. So in late 2024 and early 2025, they rushed to import everything they possibly could before the new taxes hit.
Just hoarding inventory.
Exactly. Warehouses were absolutely bursting at the seams, and that sheer panic buying kept the import numbers artificially high for the year.
That makes total sense. But there's another piece to this puzzle in the reports, and I think this is honestly the most critical part for you listening to grasp.
The AI component.
Yes, because it explains why the balloon won't pop. It explains why U.S. demand is just so stubborn, regardless of the price.
You're talking about the actual composition of what we are buying, the types of goods.
Exactly. We aren't just importing fast fashion and cheap plastic toys anymore. According to Reuters and the Fed notes, there was this massive, unprecedented spike in what they call capital goods.
Right.
Specifically, we're talking about computers, telecom equipment, and semiconductors.
This is the AI twist.
It's the AI twist. We are right in the middle of a global artificial intelligence arms race.
We really are. And this changes the economic calculus completely. See, consumer demand for things like cheap T-shirts is what we call elastic.
Meaning it stretches.
Right. If the price of a T-shirt goes up by $5, you might just say, I don't need a new shirt this month. You just don't buy it. But the demand for AI chips and data center equipment, that is highly inelastic.
because these tech companies absolutely need it to survive.
Exactly. Google, Microsoft, Amazon, they are currently building the massive physical infrastructure required to power the next generation of technology. And to do that, they need high-performance chips, specialized cooling systems, and millions of servers.
And most of that heavy hardware is still manufactured in Asia.
It is. So even if a tariff makes a server rack 20% more expensive, they are going to buy it anyway.
They just have to. They can't exactly go to their shareholders and say, oh, well, the tariff was a little too high, so I guess we'll just sit out the AI revolution.
Exactly. They will pay literally any price to get that hardware before their competitors do. And that is a huge reason why the goods deficit hit a record high. It's being fueled by massive corporate investment in technology.
You know, that distinction feels really important. When we usually talk about a deficit on the news, it always sounds like a terrible thing, like we're just a country overspending on our credit cards at the mall.
Right, like it's purely a spending problem.
But if we are borrowing money to build the infrastructure of the future, isn't that fundamentally different?
It is very different. Think of it this way. If you go into credit card debt to go on a lavish vacation, that's just consumption. That money is gone.
You just have pictures to show for it.
Right. But if you take out a loan to build a factory, or in this case, a massive AI data center, that is an investment. You are making a bet that this infrastructure is going to generate massive wealth and productivity for decades to come.
So in a way, we're importing the bricks to build the house of the AI future.
That is the optimistic view, yes. The deficit looks incredibly high right now because the U.S. economy is growing and aggressively retooling for the AI era. We are importing the means of production.
Okay, let's bring this all home for the listener. We've covered a lot of ground. We talked about the hot potato of inflation. We talked about the balloon effect of the deficit and the AI arms race.
We did.
If you're a regular person listening to this right now, maybe you're checking your 401k or you're thinking about buying a car this year, what is the actionable takeaway here? How should they navigate this?
I think there are three main things you need to watch. First, keep a really close eye on inflation, but you have to look beyond just the shiny headlines.
Right, because of the pass-through.
Exactly. Since the data shows 90% of tariff costs are passed through, and we have that indirect umbrella pricing pressure we talked about, prices might stay sticky for a while.
So don't just expect prices at the store to magically drop just because supply chains shift to Vietnam. Restructuring a global supply chain costs a lot of money.
It does. Second thing to watch is the labor market. The White House's big bet here is that these tariffs will force jobs back to the U.S.
Okay.
If we start seeing domestic manufacturing wages rising faster than inflation, then you could argue the strategy is working for the middle class. But if wages stay flat while prices go up, then it's really just a tax on your daily lifestyle.
That makes sense. And what's the third takeaway?
The third is to completely reframe how you look at the trade deficit. Don't just look at that big, scary $900 billion number and panic. Look at what we are actually buying.
The capital goods.
Right. As an investor, the fact that we are importing record amounts of capital goods for AI, that is actually a massive growth signal.
It means these huge companies are betting heavily on the U.S. economy.
It means the U.S. is still the place where the future is being built, even if we have to import the plates to do it.
I really like that framing. And, you know, that actually leads me to a pretty provocative thought to end on today. Something for everyone to chew on.
Well, let's hear it.
Maybe we need to stop treating all deficits as equal. Like maybe the whole conversation needs to shift to categorize them. There are good deficits and there are bad deficits.
I think that is definitely the nuanced take we should be having. If the deficit is being driven by heavy investment in capital goods that make our entire economy more productive, maybe the scoreboard isn't actually as grim as the politicians say it is.
Right.
But, and this is a really big but, that massive bet has to pay off.
Yeah.
If the AI boom turns out to be just a bubble, and we spent trillions of dollars importing all these highly specialized chips and servers that we don't end up needing, well, then we just have a lot of really expensive debt.
High risk, high reward.
Yeah.
But I guess that is just the reality of the market right now.
It certainly is. You can't avoid the risk.
Well, to quickly recap for everyone listening, number one, the data clearly shows Americans are largely paying the tariff tab. About 90 cents on every dollar stays right here. Yeah. And number two, the trade deficit hasn't actually shrunk. It has just moved around like air in a squeezed balloon. And it's being heavily fueled by this unstoppable hunger for AI technology.
It's a messy transition period for sure.
Yeah.
But understanding these mechanics really puts you ahead of the curve as an investor.
Absolutely. And we will keep tracking these numbers, keep reading the reports so you don't have to. Thank you so much for breaking this all down with us today.
Always happy to do it. Thanks for having me.
And thank you all for listening. Don't forget to subscribe and hit that like button. See you next time.